Here's something that is going to blow your mind. Most financial professionals cannot define cash flow in simple terms their clients can actually understand. They'll talk about operating activities or cash flow from investing activities or from financing activities, and they'll bring in that wonderful cash flow statement or statement of cash flows. They'll mention EBITDA adjustments to get to the cash flow during a period, but ask to explain in one sentence and in a way that a business owner can understand, that's a lot tougher. Here is the simple truth. Cash flow is the difference between your cash balance at one point in time and your cash balance at another point in time. That's it. So if you had $50,000 in the bank on January 1st and $65,000 at the close of the day on January 31st, your cash flow for the month of January was a positive $15,000. I know I'm oversimplifying, but that's the point. This is as simple as it gets. Cash flow, on the other hand, if you started with that same $50,000 at the beginning of January and on January 31st, at the close of the banking day, you had $42,000 in the bank, your cash flow is negative $8,000. 1 month, positive or negative cash flow, that's it. 2 points of time. Beginning balance, ending balance, the difference is your cash flow. Whether it's a daily cash flow, weekly cash flow, monthly, quarterly, annual, it doesn't make a difference. It's all the same formula. Stay with me until the end of the episode because I'm going to give you an action item that you can use this week to help a client understand their cash flow and position yourself as a superior cash flow advisor. I'm David Safir, and I'm the founder of Cash is Clear Learning Systems, and this is Cash Flow Confidence Live, where financial pros come to learn how to become a fearless cash flow advisor. My mission is to help close the clarity gap between accounting and reality so you can command premium advisory fees of $1,000, $2,000, $3,000 or more per month, focusing on what actually matters, and that's cash. Why does it matter that your clients understand cash flow? Most accountants, CFOs, doesn't matter where you are in this ecosystem, they fall into, you might be one of the people who falls into a ratio and report trap, where a client says to you, yeah, I don't understand what's going on with my cash flow. And the response would be, here's a report, here's more ratios, and you dive deeper into analysis. But what your client's really asking you is, where did my money go? Why do I have less cash than I thought I would? How do I get more cash? And they don't want another report. They don't need another report. They need clarity. And clarity helps with them understanding what cash flow actually is. Here is the 2-point-in-time framework. Yep, and it's going to sound way too simple, but this is where you can begin with your clients and they will appreciate the simplicity. Cash flow only has 3 possible states. Positive cash flow is when your ending balance is higher than your beginning cash balance. Money comes in faster than it went out between those 2 periods of time. Negative cash flow, when your ending cash balance is lower than your beginning cash balance, money went out faster than it came in. You depleted cash. And number 3, neutral cash flow. On those rare occasions when your beginning and your ending balance equals, they're the same, then it's neutral. When does that happen? When the banks are closed, mostly. Never seen it happen when there was actually money circulating. So, how does accounting confuse this? It's because traditional accounting actually creates the clarity gap. When accounting principles don't track cash, they track revenue recognition, expense matching, deferrals, depreciation, amortization. I could keep going and going. And you can be profitable on the P&L and have negative cash flow. You can show a loss and have positive cash flow. Accounting and cash are two different languages describing two different things. And your clients live in the world of cash. Their vendors want cash. Their employees demand to be paid in cash. Their landlords demand cash, and they need cash to go to the grocery store. But sometimes you'll speak to them in accounting. That's the gap. That's why they're confused. And that's the opportunity for you as an advisor. Making it real for clients. Here's how to teach clients about how to think cash flow. Again, pick the 2 points in time, any 2 points in the business. Now, most people default to month, and there's reports that say, here's your monthly cash flow statement, and money's coming in and out of inventory, and oh, we grew inventory, so that took your cash, all sorts of gyrations. Or you're creating a monthly cash flow model for the year. Okay, that's great. However, from the beginning of the month to the end of the month, on any given month, there are generally big peaks and big valleys. When you measure the difference between the two, it can be enormous. And that could be the difference between having enough money in the bank, identifying those, versus not on a weekly basis. Peaks and valleys. You can show great ending balances and go for weeks without money, but go for weeks without money in the bank. And I know this. I mean, have you ever worked for a publicly owned company? They play with this. They stop spending cash at the end of the year so they can show really great balances. Doesn't matter what it was in the middle. They do this on a quarterly basis. They play with their cash to show really good results. And they do other results that they play with, but they could be in real trouble during a given month or during a given week. So I always use weekly cash flows when I'm working with clients, because that way, if they're having a challenge or we project a challenge, it doesn't come up as a surprise in the middle of the month. Well, but here's the thing, whether you measure it weekly or monthly, after you measure, just ask the question, is it going up or down? What decisions made that happen? And what can we control going forward, which is the absolutely most important question here, because understanding what happened is not nearly as important as understanding what's going to happen and how can you impact the future. Here's the opportunity. When you explain the cash flow simply, you close that clarity gap, and all of a sudden, your client and you are living in the same world. They understand what they're looking at. They stop being intimidated by you. Yes, most of your clients are intimidated when you talk about accounting. When they stop being intimidated, they'll start asking better questions. And here is the beautiful part. Once they understand what cash flow is, they want to know how to improve it. They want to know how to make their balance higher at the beginning and end of every month and drop those peaks and raise those valleys. And that's where your advisory value lies. Not in producing reports they don't understand, but in helping them control the actual cash coming in, going in and out of their business. And that's how you can transition from compliance work to advisory work. And that's how you can command $1,000, $2,000, $3,000 or more in monthly retainers because you speak their language. You focus on cash, not accounting. So here is your call to action for this week. If you do this one thing, you can help your clients and become more confident as a cash flow advisor. Take a client and pull up their bank statements from the beginning of last month. Look at the actual cash balances on those 2 dates. Calculate the difference. That's their cash flow. You already knew that. And then schedule a 15-minute phone call. That's it. And say, I want to show you something simple about your cash flow from last month. At the beginning of the month, you had X. And in the last day of the month, you had Y. And so your cash flow was a positive or negative Z. Let me show you what drove that change. And that's it. No reports, no ratio analysis, no, just 2 points in time and the difference between them. And it doesn't matter if it's beginning of the month, the end of month, or the bank statements, from any 30-day period. Watch what happens. Your client will finally understand their cash flow and they'll ask you questions and they'll want to know how to improve it. And you'll have the door open to doing advisory work. If this resonates and you want to go deeper into cash flow strategies your clients can use and control, I put together a great ebook, Boost the Bottom Line, 24 powerful cash flow strategies you and your clients control. It is free and gives you concrete strategies that you can implement with clients right away. And some of these you'll have heard of. Other ones are probably brand new to you. Step by step, how it impacts your clients and how to implement it. You'll find a link in the show notes or go to CIC60.com. I'd love to hear how it works for you. I'd love to hear about the conversation when you talk to them about their 2 points in time. And comment on the platform wherever you're listening that you're here, or reach out to me on LinkedIn. I'd love to hear your experience because it will impact you when you write it down and you can help others. Now, before we go, I want to thank Pivot, the Unconventional Cash Flow Conference. It's a 4-day boot camp. If you're interested at all in becoming a great cash flow advisor, it's a way to jumpstart in 4 days. Go to pivot.com. I think it's been scrolling along the bottom here the whole time. PIVOT 2026. Sorry, pivot2026.com. That's obviously this year. And thank you for coming to Cash Flow Confidence Live. If you haven't already, please subscribe or follow the show so you don't miss future episodes on building your cash flow advisory practice. Until the next time, be the confident cash flow advisor that your clients want.